The Intelligent Investor: The Difference Between Investment and Speculation.
Imagine a life-changing moment where your financial future is secure, your investments are thriving, and your dreams are within reach. Now, picture the opposite: a reckless gamble that leaves you empty-handed and full of regret. The difference between these two outcomes is the difference between investment and speculation. Welcome to Nouveau Riche Investor. Today, we delve into the timeless wisdom of Benjamin Graham's The Intelligent Investor to explore the crucial difference between investment and speculation. By the end of this video, you'll have a clear understanding of how to make informed, disciplined investment decisions that can secure your financial future. Benjamin Graham, often called the father of value investing, wrote The Intelligent Investor in 1949. His work laid the foundation for many successful investors, including Warren Buffett, who praised it as the best book on investing ever written. So, what is the fundamental difference between investment and speculation? Investment is like sailing with a well-planned route, backed by thorough research and long-term goals. Speculation, on the other hand, is akin to diving headfirst into the waves, hoping for the best without a clear plan. Graham introduced the concept of Mr. Market, an allegory for the stock market's fluctuations. Mr. Market is often irrational, driven by fear and greed, leading to prices that do not always reflect the true value of the underlying business. Investing involves a thorough analysis of a company's fundamentals and a long-term commitment. It's about understanding the intrinsic value of an asset and holding on to it until its true worth is recognized. Speculation, however, is like gambling. Decisions are based on market trends and prices, not the asset's value. Graham emphasized the importance of a disciplined approach. This means adhering to a strict set of criteria when evaluating potential investments. For instance, look for companies with strong balance sheets, steady earnings, and a history of paying dividends. Here are some key criteria that Graham suggested for value investors. Price-to-earnings ratio, PE ratio. Look for companies with a low PE ratio compared to the industry average. Price-to-book ratio, PB ratio. Focus on companies trading at or below their book value. Dividend yield. Look for companies that pay dividends, demonstrating financial stability and a shareholder-centric approach. Earnings stability. Choose companies with a consistent track record of stable earnings over the past decade. Financial health. Evaluate the company's debt levels and ensure they are manageable. Many successful investors have followed Graham's principles. Warren Buffett, one of the most famous investors ever, credits much of his success to the lessons in The Intelligent Investor. Buffett's disciplined approach and focus on intrinsic value have made him a billionaire many times over. The key to successful value investing is patience. It's not about making quick profits, but rather about building wealth over the long term. This requires discipline and the ability to hold on to your investments during market downturns, trusting that the true value of your holdings will be recognized.
In conclusion, understanding the difference between investment and speculation is crucial for your financial success. Investing is about making informed choices based on careful analysis, maintaining discipline, and having the patience to see your investments through. By following these timeless principles, you can build a portfolio that not only survives market swings, but also grows steadily. For a deeper dive into these principles, I highly recommend reading The Intelligent Investor. Stay tuned for more videos where we'll explore each of these concepts in detail. Until then, happy investing. Make sure to subscribe for more content from Nouveau Riche Investor.